Markets have begun to take a breather after a volatile first quarter, with signs of stability starting to show. U.S. earnings season wrapped up on a strong note. Treasury markets are also settling, and the Fed is holding steady. But with trade tensions lingering and gold holding its ground, questions remain about where volatility heads next and what that means for business sentiment. I'm Johanna Bota, and today I'm joined by Matt Weller, StoneX Head of Global Market Commentary. Welcome, Matt. Good to have you with us. Let's start with indices. With the Trump administration dialing back its rhetoric a bit and U.S. earnings season now behind us, is market volatility back to normal?
Well, that depends on how you define normal. Looking at the VIX, it's a little bit higher than most of last year, but it's near the average of the past 15 years. So I think we are back to what many would consider a normal environment after a low volatility environment last year. A couple factors driving that include Q1 earnings season, which was generally stronger than expected, driven by ongoing AI spending and particularly ongoing strength in the consumer, which we saw from the credit card companies, from major retailers. And I think as long as people retain their jobs here in the US, that consumer spending will continue, and that should have a dampening effect on the VIX. One thing to have on our radars, though, is the pause on the 90-day reciprocal tariffs is expected to come to an end next month. We've seen pretty minimal progress on any sort of trade deals. So I think that's something that's sneaking up on markets and could lead to some volatility, some uncertainty as we move through the month of June. The other factor to watch is the big, beautiful budget bill that's winding its way through Congress as we speak. And if that sees any sort of disruptions, that could also lead to volatility, as traders are essentially pricing that in and a massive fiscal stimulus that should be supportive for stocks and, again, dampen down volatility. So those are the key factors I'll be watching.
And implied volatility in treasuries has followed a similar path. It's declined sharply from the mid-April highs. Now, since bond prices are closely tied to monetary policy, and with the Fed expected to hold steady for now, could we see the MOVE index remain relatively stable in the near term?
Well, monetary policy does have a direct impact on volatility in the treasury market and long term interest rates. It's not the only factor to watch. And I think, again, going back to that budget bill, we've seen some concern creep in about the never ending US deficits and the ongoing accumulation of debt. So that's something to consider from a longer term perspective beyond just Fed policy. And then any sort of changes to inflation could have a big impact as well. And that looks likely to pick up in the coming weeks and months. What I would note, though, is that the probability of a trade driven recession is reduced. Actually, as we're recording, we've just had news that President Trump and President Xi have hopped on a call together. So perhaps progress toward a US China trade deal is going to be a key factor to watch if you're trading treasuries and for volatility around there. As for the Federal Reserve, I think we're likely to remain on hold at least through the summer. So, at the next meeting in June and then again in July. When we start to get into September, if there's a lot of uncertainty about what the Fed will do there, as there currently is, though, of course, we'll have lots more data on inflation and the jobs market until then, that is where we could start to see volatility pick up. But it does look likely that we could see maybe a step down from where we were back in April in terms of treasury market volatility as we move through the summer, and then pick up again, I think, as we move into the fall.
And I want to move to gold now, because even though this safe haven asset is off its April highs, daily chart still shows strong support, and the GVC, although it's down, hasn't fallen as much as its counterparts. Why is that?
Well, gold remains in a secular bullish trend. And generally, when markets are rising, driven by long term factors, that tends to have a dampening effect on volatility. We did see volatility and expected future volatility in the gold market peak when the tariff uncertainty was the highest back in April. But now we've seen prices mostly consolidating. That's brought volatility in for gold. What I'll be watching moving forward is a potential breakout to new highs in gold. If we can get above, say, the mid 3400s, that could renew the uptrend in gold. And especially if it's driven by some of those concerns about debt loads in the US and really across the globe, that's where we could start to see volatility pick back up again. Probably not to the levels that we saw in April, but certainly above where it's receded to now. One other factor, again, is going to be trade stability. If we have any sort of environment where there's not that concern about tariffs, about some of those ongoing trade tensions, basically an environment where traders have more clarity on what's coming in the future, that's been a big factor driving gold higher. So if we start to get that, maybe gold settles down and we could see volatility remain low. But I would expect a potential breakout to the top side in gold. And if we get that, that's where volatility could pick up again in that market.
That's some wishful thinking, Matt. So, aside from any major trade announcements or U.S. Federal Reserve decisions and comments, what other events could trigger market volatility? And what does it mean for business investments?
I would point to those trade developments. I think those are the most salient and timely factor driving volatility in this current environment with the pause on reciprocal tariffs just a month away. That said, I don't think we're likely to see an environment with tremendous uncertainty like we saw previously. So, if anything, perhaps we get another delay, though that is certainly something traders want to have on their radars. The last thing I'll note, we're recording this ahead of Friday's NFP report out of the US, but if we start to see any weakness in the US labor market, that's where we could see that consumer spending come in, more volatility come into the stock market, and concerns of a recession on the rise again. So, labor market data, specifically non farm payrolls, but for a more timely indicator, initial unemployment claims will be the things I'm monitoring for the health of the consumer, which again has had a stabilizing impact on the stock market in really for years now, and certainly in recent weeks. As long as that remains, volatility could remain low. But that's a factor that's been showing some cracks. And if those cracks widen and we start to see fears of a full blown recession, volatility may just be hibernating and not gone away for the rest of the year.
All right. Thank you, Matt. And thank you for watching. For more financial content like this, don't forget to like and subscribe to our channel.